24th, the second day of Davos. Kind of feels like Davos in the desert when there's no snow around, but it's Davos in the mountains without snow. But I have to admit, it feels a little bit uncomfortable seeing Davos happening at this particular moment. Just a kind of a sidebar, not that it's relevant, but it just feels like, is it really a good time for all the rich and powerful to be meeting in the mountains, sipping champagne? I don't know. It just seems like bad optics. But that's totally irrelevant to our conversation this morning as oil prices open a little bit down. Again, this little bouncy up and downy thing, 1% down. It's sort of opening in Asia, $1.33 on Brent lower. So we're trading at around $112 a barrel. Let's kick off this morning with the always reliable Matt Stanley, director of Star Fuels. For the last time, the director of Star Fuels, the rumor has it, on GI Rumor Mill, hashtag GI Rumor Mill, Matt Stanley is moving on. Finally, he's landed the job as Arsenal coach, and off he goes to take them into the Europa League. It'll be a great season. Matt, best of luck on your new beginnings. We look forward to hearing what it is. But for now, oil markets, what's your outlook this Tuesday morning?
Morning, Sean. Thanks for that, mate. Yeah, you can expect an article in the Daily Mail at any stage now.
McDonald's, Burger King, I don't know.
Yeah, exactly. Both of those.
Both. There you go.
Oil markets. I mean, look, fundamentally, taking a bit of a pause. Like you said, it's stuck between this 110, well, really $105 and $115 range until we really see more aggressive news about recession or more aggressive news from the EU about an embargo on Russian oil. It seems that Hungary are digging in their heels, much to, I think, the frustration of Germany and the leaders, de facto leaders of the bloc. Prices are still at record highs. Let's look at diesel again. I use that as an example, but it's such an important end user product that I think it's the best analogy to use. There's barely 25 million barrels of storage left in the US East Coast. It's quite a grave situation. And the best thing that Grandpa Joe could do yesterday was say, don't worry, we'll release some from the reserves. They don't hold more than 1 million barrels of reserves of diesel. So it's a complete, it means nothing. All it does is that it highlights the fact that the US East Coast is running out of diesel. And that will highlight more panic, now and increase prices. Look, last week we saw again, there was a big fire in an RFCC unit in a refinery in Korea, the Essar refinery, one of the world's biggest. Gasoline margins jumped $8 a barrel on that news. The market is so fragile when it's coming to the amount of oil that is available that frankly, I can only see it going one way. If the end user demand is there, and JP Morgan is saying the consumer is fine in America, clearly demand is fine, supply is the concern, and we're rallying 25% on the back of one fire out of one refinery that didn't even, I think they're restarting it tomorrow. And yesterday it collapsed back down $8 a barrel. But the market is so fragile when it's coming to all balances. One headline is going to cause a $10 rally. And that's the market will be in until we hear from one side or the other.
Well, let's go to Clyde Russell, Asia Commodities and Energy columnist at Thomson Reuters, to give us a little insight from a China perspective on where or if any of this demand destruction may come from in order to be the sort of bearish side of this argument. Clyde, your column this week pointing at China's stimulus to get the market moving there. China's kind of fallen into that gap between, is it still stuck in a COVID nightmare, or is it coming out and demand will come back? Where is demand in Asia at the moment?
Well, I think as far as China goes, you have to kind of separate out what they're actually stimulating at the moment. And the moment they're really providing stimulus to construction, infrastructure, and things that really boost metals demand. Yes, there will be some additional diesel demand as they ramp up building and that sort of thing. But what they're first doing is really looking at metals. As far as their oil demand goes, I think there's quite an interesting contrast in China at the moment. We're still roughly about 1 million barrels per day down because of their COVID lockdowns. There are some signs that those are easing and getting back to normal. So you might expect that million barrels a day will come back at some point. But the other thing that you got to also look at is China has actually been importing more oil than it needs, especially on the latest figures for April. There were excess imports of about 1.2 million barrels. Now, that will have just flown into storage tanks. So it doesn't necessarily mean that even as their demand comes back, that we're going to see this huge leap in China imports. One thing that is interesting, and Matt sort of was talking about this, is the sort of lack of diesel and what, to me, are insanely high margins for producing diesel. The only place that really has the spare capacity to solve this, diesel dilemma is China, but they've really stopped exporting diesel altogether. I mean, they're down to about 100,000 barrels a day in April. That's probably going to even drop further in May. And yet they were doing as much as 500,000 barrels a day of diesel exports as recently as, the last quarter of last year. So you suddenly lost
just
a
on
lot
that
of
point,
diesel out.
Why aren't they, given the economic opportunity?
Well, there's a couple of things there. Initially, a lot of it was they wanted to limit pollution over winter, especially as the Beijing Olympics were coming around. So refineries are fairly polluting, fairly energy-intensive things. So that was part of it. And then the other thing is they didn't really want to be importing crude oil at a time when they deemed the prices to be unreasonable. So they didn't want to be stoking demand for crude and pushing the price higher. So they just didn't issue any export quotas. So the refiners that normally export, both their big state-owned ones and their smaller independent ones, just basically have exhausted their quotas. And there haven't as yet been any more issued. Now I'm expecting that by July, at the latest, there'll be no quotas left. Now that doesn't mean that they won't issue some in the coming months, but it does mean at the moment, we're not really expecting a sort of flood of imports of crude into China and exports of refined products out, even though it would be very profitable to do so. My question, my little niggling at the back of my head there is, if they were really looking to stimulate their economy, this is a really cheap, easy, fast way to do it. Just buy more crude and then pump out the products. You get a lot of nice economic value out of that. But
especially at this particular moment. Especially, let's go to Pakistan with Osama Rizvi, energy and economic analyst, Primary Vision Network. Osama, I'd welcome all of this noise, all of this high prices, all of this inflation in the world. We've seen it start to have a really kick into Sri Lanka as the sort of poster child of the sort of scale of the economic collapse coming out of COVID and this a heightened sense of cost of everything. How is Pakistan doing and its new leader and countries comparable to it in your neighborhood, that 100 to 200 million population, which is clearly in the emerging economy status? Unmute. We don't want to silence 180 million Pakistanis. They will get very cross.
Absolutely. 220 million, I think now. Oh yeah, we've been progressing in the wrong ways. But the thing is, right now, Pakistan is heading towards the path where Sri Lanka was, but I don't think we'll go for a default. However, things are pretty bad. Things are pretty bad because of two factors: international and domestic. Domestic, there's a lot of political instability, which is interestingly because of growing inflation, because of growing food prices. Especially Pakistan is, in terms of vulnerability to higher food prices, Pakistan is on the second number after Nigeria. So that the heat wave, there is a lot of load shedding the blackouts. There are storms. There is a water crisis going on, and especially in terms of finance as well, we are seeing extraordinary high interest rates. Business activity is slowing down. Our GDP growth is expected to fall. We are going to post the largest ever fiscal deficit in the history of the country as well. So all of these figures, I mean, I can go on, but
all of the wrong biggest and largest and
yes,
most and
yeah,
in all of that, I mean, some of the sort of positive sort of commentary, not positive commentary coming out of Davos about the challenge to the world food supply and pointing quite clearly at Russia's sort of unwillingness to allow Ukrainian grain to flow out of Odessa. They've got a military sort of naval blockade of that port. Do you see any soundings of blame about between food scarcity, food prices, and Russia's position in the conflict in Europe? Is there any kind of correlation? Is that a narrative that is gaining traction in Pakistan?
yes and no. I mean, mostly, I personally believe while international food price inflation has certainly played its role, most of the issues are also domestic. So there is hoarding, there is the middleman who is trying to reap as much as profits as possible. There is a structural issue in the agricultural sector where our yields have been falling down. The alluvial land, the fertile land, has been giving away to the properties, to new societies, to housing schemes. So, I mean, these are the main factors that are playing its role. Yes, international food prices are rising. They are on their, UN's food price index is at its highest since its inception. But I don't see, especially in Pakistan and the complicated love-hate relationship with Russia and the US. So I don't see this narrative taking a strong hold here. But nonetheless, all of these intrigues, all of these developments are affecting not only Pakistan, and I've written a lot about this, emerging markets actually. They are affecting the developing economies a lot, quite asymmetrically, actually. So,
well, as described by the UK central bank governor last week, a rising challenge of food prices he described as apocalyptic. Matt Stanley, also coming out of Davos in recent yesterday, was this ongoing narrative that the Saudis seem to be banging quite hard in recent days and weeks, and that is the outlook for the lack of investment in the oil and gas supply looking forward. They continue to point to that as a big problem. My question to you is, there's a lot of noise being made about whether the Russian embargo, the EU embargo in Russia goes into place today, yesterday, in 5 hours' time or whatever. But ultimately, the train has left the station there. And I wanted to welcome your thoughts on that over the medium term, 3 to 5 years here. The Europeans are going to be buying a lot less of Russian oil products and crude. International companies will be investing a lot less money and technology into Russian oil reservoirs and fields. Any which way you cut the cake on this now, over 3 to 5 years, there's going to be less Russian oil supply than more. What are your thoughts on that?
I think that's an excellent point. And I think I can't argue with what Saudi is saying. He's right. And His Excellency Al Masroui, the energy minister for the UAE, he said the same thing. I think what it's done, what it's highlighted, Sean, is a flaw in international energy policy. And that, look at the US, and I bang on about this all the time. Where is US oil? Like Clyde said, margins are extraordinary high. Everyone who's putting oil into a refinery and produces either gasoline or diesel is making a lot of money. This time last year, the refining margin for diesel was about $10 a barrel. Today, it's 40. Prices have gone up 100% in the US in the last year. The end user is there. So I think what
also has gone up, Matt, is the price of a rig in the shale oil patch, up something like 30% this year, and all of its associated costs.
Yeah, I agree, but it's not linear compared to where end user prices have gone. So Margins are still there and they're excellent. So look, I think the other thing that the Saudis came out and said yesterday that was very interesting was that Russia will be part of OPEC Plus. That's very much part of their of the plans. And what we'll see in the coming months will be a new agreement within OPEC Plus. I don't think that this is the end of supply curtailment, or that the group will say to the market, we will do what we have to when we have to. I think they're going to leave it open. And it looks like Russia are very much part of that conversation. The issue that people have got is the ambiguity about the embargo in the EU. 49% of the EU's diesel comes from the North Baltic ports of Russia. You can't just replace that overnight. If you do, it comes from an Aramco in the Red Sea, it comes from a Reliance in India, or it comes from the US Gulf Coast. That means margins will only get higher. As soon as that EU embargo is announced, cracks will only go bid, and that's the way it's going to go. But it seems that there may not be a sanction on US diesel. It may be on on Russian diesel. There might be, but there will be one on Russian crude oil. Look, it's very much up in the air. But one thing is for sure is that refining margins are there. And as Clyde said, once China, I think they will increase its export quotas because they're going through a bit of a brutal time. The property sector in China is still in a very grim place. And I think that if they can make some money on their energy policy and increase their export quotas, I think that will ease tensions in the EU. So the coming months are going to be key for changes in policy, I think.
Yeah, it seems that it's somewhat, regardless of where things go on the front month in terms of this EU embargo or not, strikes me that this paradigm has shifted regardless. And where are all the new pipelines going to be built? Where are all the new flows going to go? All of those structural changes are underway. But Clyde, I wanted to look a little bit at your neighborhood this morning. We've got a new Australian Prime Minister meeting for the first time with the infamously named Quad, the new security partnership in Asia, India, the US, Australia, and Japan. Nonetheless, this and commentary by the US president about Taiwan, which is kind of moving the sort of posture of the US, the ambiguity of the US position on Taiwan. All of this geopolitics, how do you see it impacting Asia on the outlook, and particularly for the flow of the structure of supply chains?
Well, I'm not a geopolitical analyst, so I'm always cautious what I say about that. But to me, it seems that it's almost a continuation of what we've been seeing for a while. Is the Quad as such is almost formed as a counterweight to China to balance out China's influence in the Asia Pacific region. So I think the new Australian Prime Minister probably has a better opportunity of improving relationships with China, but it's not going to alter the balance. Where is it going to leave Australia then? I mean, all of the stuff you dig out of the ground and send to China every day, and at the same token, you're building this nice little Quad army to slap them around. How is that going to coexist? Well, I think it's quite simple. It's you buy our stuff and give us the dollars for it, and we'll use the dollars to build submarines and stuff like that to make sure you don't get too uppity. I mean, that's really how the thinking goes. The Chinese thinking, of course, will be completely different. It will be, we'll buy all your stuff for as long as we need it, and we'll use it to build our economy. So eventually, we're stronger than you. So you've got this kind of dynamic going on.
One of the things Christine Lagarde said yesterday, vis-a-vis again the Davos commentary, was that there's many things at this moment is a tipping point on. One of them is the supply chains. The geopolitics of supply chains are going to trigger a significant change to obviously make everything in China and ship it all over the world, and so forth. That could be whether the Chinese want to keep buying your stuff or not. That alone could affect the outlook for raw materials, or at least the direction of them in Australia or out of Australia.
Well, I think the Chinese have no choice, especially when it comes to iron ore, which is, of course, our biggest export to them. And they've got limited choices when it comes to LNG, especially with the current situation. And you saw what happened when they, self-sanctioned, said they wouldn't buy Australian coal anymore. I mean, Australia was still able to sell all its coal at a much higher price to other buyers. So, on that case, the Chinese actually, in a way, screwed themselves because they were forced to buy coal from other people at a higher price than they were paying Australia. So I think it's much the same with the whole Russian situation at the moment. Is in some ways what you're really seeing is I don't expect there'll be a massive fall in the amount of crude Russia actually exports, but it will change who buys it and how long the shipping voyages are and how much it costs to go up around that sort of thing. So in the end, sanctions do hurt the country that they're imposed upon, but they also tend to hurt the countries imposing them, especially over the longer term.
Let's go to the survey question this morning, which sort of gives everybody else a chance to give their view on this thesis. An EU oil embargo in 2022 or not, regardless, Russian oil output will be lower in 5 years than today due to the withdrawal of international companies. We've had all of the withdrawals already. Maybe they haven't sold off their stakes in Rosneft and I don't know what, but Halliburton's moving out, and Vitol's leaving, and Schlumberger's gone, and all of that stuff that train's already left the station, regardless of whether there's oil in the pipeline for the next 6 months or not. So the Russian oil output over the medium term is definitely injured here. That's the thesis. That's the question. And where does that leave things? Osama, on the point, I was in a discussion yesterday and really keen to get your views on it. We've just announced here in the UAE, we're going to be building an export LNG facility in Fujairah, 10 million tons, all of the costs associated with that. There was discussion for a long time, would it be a floating regasification unit? My thoughts through Asia, firstly in Pakistan, where you do have a floating FSRU, is there any potential, do you think now, given the rise in LNG costs, to build permanent onshore facilities?
Unfortunately, no. There should be, and I've been advocating for such developments from quite a while, but there isn't. Even in terms of oil, we import 65% of our energy, and our import bill, which is doing a lot of damage to the overall country's reserves, which are now less than $9 billion, only to cover 7 weeks of imports. So even in terms of that, we don't have any proper storage facilities. So there is a lot of work need to be done on the element of energy security. We have only two tiers at our Port Qasim in Karachi, and one of them is not working. One which is working only works half of the time. So that is a real concern. Pakistan has ended up signing one of the most expensive LNG deals recently. It was in the news quite a lot. So I don't think policymakers are right now really getting their minds onto these things, because there are a lot of other domestic issues going on. The current government, to be honest, is in a fix right now, whether to take the unpopular measures and hurt their political capital, or to consider these things that should be done. So unfortunately, no, there isn't any development on that regard.
Matt, I suppose the surprising story of the week to me is, we have it in our digest today, and that is that business confidence in Germany actually rose in May, which is just quite an extraordinary thing, given that, at any time, Mr. Putin could turn off their lights. That despite everything, there is a pretty buoyant German economy. The DAX has come off, but nothing major. We saw a big rally in the stock market yesterday. The growth story is still there, despite this sort of outlook for inflation.
Yeah, look, it's I think apart from China, I think most economies would be the same. Jamie Dimon said yesterday that he probably sees a recession, but it will be a recession that none of us have ever seen before. I mentioned to you before that I think the world could go through a recession by Q4, but still have $100 oil in it. It's a new world order, and
a recession with full employment. I don't know what that's called exactly.
Yeah, well, that's like Man United winning the FA Cup again. It's never going to happen, sure. But that's 1-1, right? It's 1-1. No,
there you go.
It is a new world order. I think that has fear been priced into the oil market regarding Russian oil, and has fear been priced in that a recession is on its way? There is so much, like I've said, that is pending. People are waiting for decisions to come, data to come out. That I think when that time comes, then people will deal with it. But at the time being, demand is still there. Supply is an issue. People are still buying things. People are still borrowing. Why not bid the market up? Why shouldn't you? I mean, Bitcoin has treated it as sort of raised its head. That it's not that asset class that people want to get into. I agree.
But it's holding at 30,000. Seems to be a floor, $30,000 for a little bit of some kind of digital code. It sounds like a tulip in Holland 400 years ago.
Exactly. It's a tulip market, absolutely. But it's worth half what it was worth 4 months ago. So, I don't know, you guys.
Clyde, on that point, what is the data point you're waiting to drop for some clarity? Lockdown in Shanghai? I mean, what is the data point of most relevance, do you think, for the direction of the oil markets in the second half of the year that needs to drop?
Well, I think at the moment, as Matt says, there's just so many balls in the air that knowing which one is going to drop first and how it will fall is the real challenge. For me, I look at a few things. I want to see what is happening with China crude imports and then subsequently product exports, because obviously that comes with a bit of a lag. I want to see if they actually manage to reopen their economy and get, stimulus for metals first, and then, stimulus for energy commodities second. So I'll be looking to see if those things actually start to come through. Also, just looking at how those flows go. Will much more Russian crude come from sort of, the European side, their Baltic ports? Will that actually travel all the way around into, the Indian Ocean to go to places like India? I'll be looking to see if that actually is going to be a significant flow, or if it's just going to be something marginal. I think there's still, so many uncertainties, but, it's, how can I put it this way? The temptation is to see all the risks and not actually see the positives. So I think, quite frankly, if I was looking at China, the risk is for higher oil demand and not lower oil demand. I think the risk is that there's probably, Russian crude, probably more of it stays in the world market than we might think, which might be, that's possibly bearish for prices, but it's just not currently what the market is thinking. So I tend to look at, what the market is really fearing, China slowdown and Russian crude, and think that the opposite of those things are actually more likely by the second half of the year.
Is there a reason you could identify, Clyde, just to quickly follow up on that China won't repeat? Why wouldn't they repeat 2020? They're getting heavily discounted Russian oil, and they need to refill their inventories.
Well,
do they have the capacity?
There is a question as to how much they need to refill inventories, in fairness. Because they haven't actually, over the last year, 2021 and up to so far this year, they've still been adding to inventories, not at the pace they did in 2020, but they've still been, they have more crude available than what they've been refining. So they have still been storing. I think the Chinese love a bargain. I mean, who doesn't? So I expect them to buy as much Russian crude as they possibly can. But not every Chinese refinery is able to take the type of crude that Russia will be providing. And it's the same case in India. As we know, refineries are more complex beasts than many people think. So you're not going to necessarily say, well, we're just going to stop buying this type of crude and start buying Russian crude, and it's like for like. You have to have the right type of refinery configuration to run your Russian crude. So I think there is a limit to how much the countries that don't really buy into the Western idea of sanctions on Russian crude, I think there's a limit to how much they can actually take. Whether it will be enough to offset what the Russians are likely to lose in Europe, that's the big question that still needs to be answered. I have a feeling that it's probably more than people think will still flow out of Russia. But you've got to remember, it's going to be longer sea voyages. It's going to be more costs on freight and insurance and things like that. And that sort of disruption, as we saw in the coal market when China banned Australian coal, that sort of disruption lasts for a long time and causes a structural shift in pricing. And it's not cheaper.
It's like we're seeing in the US now, the price of gas is soaring because of the LNG market growing in Europe for American gas. Osama, let's give you the last word here this morning and get the survey result. See what the view of the room. Oh, Jesus, 100%. That's a bit more than I had expected. I don't think I've had that before. Always know it's a bad question when everybody agrees. Osama, I wanted to get your thoughts. Slightly abstract, but I think certainly relevant to the stability of the neighborhood. We saw CNN point the cameras again at Afghanistan after a long time over the last few days. Christiane Amanpour has been doing some fairly comprehensive reporting on the situation there. And I mention it because it obviously has contagion consequences for the neighborhood in which it sits, as it always has, Pakistan being a key part of that. And now we have the Quad, China, Pakistan being on different sides perhaps of that Quad. What does Afghanistan look like now and its potential to be a disruptor to the neighborhood once again?
Look, so if the current government's hold, I mean, if it stays, which is not looking very possible given the economic context we are operating in.
The current government in Pakistan.
Yeah, in Pakistan. So the current government has what I would term, as compared to the previous government, they have a non-confrontational policy, foreign policy, and they are very keen and very compliant, I would say, to the demands or to the policy of the US, right? So that sorts of gives me a likelihood that things would remain stable in terms of Afghanistan. However, and this is very likely because I don't think that the incumbent government would go on for more than 2 months. If that happens and the previous government comes in, Imran Khan, so he has more of a confrontational policy. He is more like into a challenging mode. So there was a lot of conflict between Biden and Imran Khan, the phone calls and stuff. So in that case, one might see a little bit of some sort of issues, some sort of problems pertaining to Afghanistan. So it would depend upon the government that stays in Pakistan for the next remaining year.
Okay, well, we need to leave it there. This Tuesday morning, the 24th of May, oil prices, as we said, trading in Asia a little bit lower today, a little over $1 down. Let's thank Matt Stanley, as always, for his insights. Clyde in Australia, great to have all of your insights, as well as Osama in Pakistan. Great to get the insights from Pakistan every few weeks, because clearly a very, very important country for the region. So thank you very much. We'll catch up with everybody 10:30 every morning. All the best.